Welcome to Iron Financial. This is the only place that puts companies on the anvil and just hammers away until the truth comes out. Look, our entire mission is to stress test your portfolio, find every single weak point, and help you forge something that can actually withstand any market storm. Today, we're putting analog devices, ticker ADI, through the gauntlet. We're going to find out if it's made of solid steel or just some cheap alloy.
All right, let's get right to work. On the surface, Analog Devices looks like an absolute fortress. The headlines are screaming buy, the stock chart looks like a rocket ship, and Wall Street is literally tripping over itself to sing its praises. They're selling you this story of impenetrable value in the semiconductor space. But our job here is to look for the cracks in those walls. Is this a solid gold investment, or is it just gold-plated hype? To help me swing the sledgehammer, I've got our market skeptic. Happy to be here. My job really is to be your eyes and ears, to make sure we're not just buying the glossy brochure the company is handing out. Momentum is a powerful, powerful force, but you got to remember, it can just as easily send you to the moon as it can send you right off a cliff. So, let's find out which direction this rocket is really pointed.
Exactly. So before we can start tearing it down, we have to build it up first. We are going to construct the bull case using the company's own blueprints, their 2026 proxy statement. This is the story they are telling their own owners, the shareholders. This is their vision of some unbreakable fortress, and we need to understand every single brick before we start looking for those weak spots.
Now pay close attention to the language they're using here. This isn't some wishy-washy corporate speak. This is pure, uncut confidence. The lead independent director is basically telling you, hey, we ate that 2024 downturn for breakfast, and now we're putting the pedal to the metal for 2026. Words like momentum and confidence in these official documents, they're like flares shot into the night sky. They're signaling to the entire market that from the inside, this company looks like a juggernaut. They're telling you that any short-term problems are just little bumps in the road on their way to total domination. This is the story they desperately want you to believe.
But a story is just that, a story, until you see the numbers to back it up. I mean, talk is cheap, but financials, well, they're bedrock. So we're done with the blueprints for now. Now we're going to look at the actual concrete and steel. We are drilling right into the core financials to see if this company can actually carry the weight of all this optimism. This is really where the contenders get separated from the frauds.
And the very first pillar of this fortress is a big one. Top-line revenue, $11 billion. Just let that number sink in for a second. In the brutal, cyclical world of semiconductors, a number this big tells you one thing and one thing only. This company is an absolute monster. This isn't some scrappy little startup. This is a heavyweight champion, a titan of the industry. This $11 billion figure, it's the foundation of the entire bull case. It is the first thing they want you to see, and it's designed to just take your breath away. It screams market dominance, insatiable demand, and a company that is firing on all cylinders.
But revenue? That's just the opening act. The real story here is the profitability. I mean, just look at these margins. On an adjusted basis, a gross margin of nearly 70% and an operating margin of almost 42%. These are the kind of numbers a king makes. This isn't a company just selling chips. This is a company printing pure cash on every single wafer that comes off the line. When you're making 40 cents on every single dollar of sales, you don't just compete in the market. You pretty much own it. And it's not just the margins. That free cash flow, $4.3 billion, that is pure, unadulterated financial firepower. That's the money they can use to reward shareholders, to crush their competitors, or to fund the next generation of world-changing technology. This is a financial juggernaut.
And this juggernaut, it isn't just moving, it's picking up speed. The data we're pulling from IndexBox shows that year-over-year revenue growth last quarter was a blistering 25.9%. But here's the real kicker. The forecast for the next quarter is even higher, at 28.5%. The growth is actually accelerating. This is what pure momentum looks like on a chart. It's a sign that the market wants what they're selling and they are executing with just brutal efficiency. They're not just hitting their targets, they're smashing right through them and asking for more. This is the kind of chart that gets every single trader on Wall Street salivating.
Whoa, hold on, let's pump the brakes a little bit. You're painting a really beautiful picture with those adjusted numbers. Adjusted this, adjusted that. But let's look at the real numbers for a second. The GAAP numbers. The ones they actually have to report to the government. The GAAP operating margin is 26.6%, but the adjusted one is this magical 41.9%. That's not a gap, that is a canyon. So what exactly is in that canyon? What are they adjusting away? Oh, things like acquisition-related expenses. So they're telling you to just ignore the cost of buying other companies when you look at how profitable they are. That's like buying a new car and telling your spouse to ignore the monthly payments when you're making your budget. It's a complete fantasy. They're showing you the brochure, not the bill.
You're right to be skeptical of adjusted numbers. We always are. But the fact is, the professional analyst community, the people who get paid big money to tear these companies apart, they have seen all of this. And they are still overwhelmingly bullish. They've read all the footnotes, they've done the math, and they're all pointing in the exact same direction. So, let's take a look at what the so-called smart money is doing. The herd is stampeding, and you really have to ask yourself why.
Look, this isn't a couple of rogue bulls here and there. This is a full-blown stampede. Look at this timeline from Guru Focus. Stifel, Oppenheimer, BOFA, Susquehanna, Barclays, Cantor Fitzgerald. I mean, it's a who's who of Wall Street, and they're all falling over each other to raise their price targets. Cantor is calling for $400 a share. This isn't just optimism, okay? This is a market-wide vote of confidence. This is the big money just flooding into a stock. This is what a Wall Street darling looks like. Or it's what a bubble looks like right before it pops. I mean, let's be honest, analysts are notorious for chasing momentum. It's easy to be a bull when the stock is already going straight up. It's a lot harder to be the one who calls fire in a crowded theater. So is this a series of brilliant independent analyses, or is it just a bunch of lemmings following each other off a cliff? The momentum is real, I'll give you that, but I'm not convinced the foundation is.
All right, let's get down to the bottom line then. Where does all this supposed strength actually show up in your brokerage account? Because a great company that doesn't make its owners rich is really just a hobby. We're here to talk about real money, real returns. Let's see if ADI is actually delivering the goods to the people who own the stock. This is the moment of truth.
And the truth is, the payoff has been absolutely massive. $24 billion. That is how much cash ADI has pumped back into the pockets of its shareholders over the last decade, through dividends and buybacks. This isn't some fairy tale promise of future riches. This is cold, hard cash in hand. It's a crystal clear signal that management knows exactly who they work for, the shareholders. And their primary job is to make those shareholders rich.
And you can see the results of that philosophy right here on this slide. On the left, you've got the stock performance. ADI hasn't just beaten the market, it has completely humiliated it. A total shareholder return of over 375% in the last 10 years. That's not just winning, that's a knockout punch. For every single dollar you put in 10 years ago, you'd have almost 5 today. That is a wealth compounding machine. And over there on the right, you can see how the people running that machine are getting paid. We'll get to that in just a minute. A machine, all right? A machine for making the CEO outrageously rich. While you're mesmerized by that pretty chart on the left, I'm looking at the ugly truth on the right. $54 million. That is what the CEO, Vincent Roche, earned in a single year. $54 million. Yes, the stock has done well, but is any human being really worth that much money for a year's worth of work? That's not a salary, that's a lottery win. When you see a number like that, you have to ask yourself, is the board of directors actually working for the shareholders, or are they just a rubber stamp for the CEO's personal ATM? Look, the CEO pay is a big number. There's no doubt about it. But you can't sit there and say they're only rewarding the C-suite. Look at the dividend. For long-term investors, this is the bedrock. According to Dividend Max, they've raised their dividend for more than 10 straight years. That's a promise they've kept year after year after year. And look at the dividend cover, 2.5 times earnings. They're earning 2.5 times what they're paying out. This dividend isn't just safe, it's bulletproof, with plenty of room to grow. This isn't some company sweating to make its payments. This is a company that is effortlessly showering its owners with a rising tide of cash. That's a foundation you can actually trust.
All right, my turn. We've admired the steel frame and the shiny facade. Now it's time to bring in the inspector and look for the cracks in the foundation. We're moving past all the performance numbers and looking at the structure of corporate governance. Because a beautiful building with a faulty foundation is nothing but a death trap. We need to know who is overseeing this $54 million CEO and whether they're even equipped to handle the job.
And here it is, the first major crack in the foundation, and it comes from their own mouth. This is the board's report card on itself. And of course, they give themselves a perfect 10 on strategy, but just look at the bottom. Risk management and cybersecurity, a 2 out of 10. Let me repeat that. In a world of cyber warfare, supply chain chaos, and geopolitical nightmares, the board of a critical technology company admits that on a scale of 1 to 10, their ability to handle risk is a 2. That's not a crack. That is a gaping, bottomless sinkhole right under the CEO's office. It's a stunning, frankly terrifying admission of incompetence in the very areas that could kill this company overnight. And if you don't believe me, just believe them. This is from their own list of risk factors. You know, the fine print they hope you'll never ever read. They are telling you, right there in black and white, that they are worried about political chaos, trade wars, supply chain breakdowns, cyber attacks, and AI going rogue. They are giving you a roadmap to their own destruction. And as we just saw, the board of directors has openly admitted they are completely unqualified to navigate that map. The company is screaming danger, and the people in charge are admitting they don't know how to drive. This is a 5-alarm fire of corporate governance, and it's burning right in front of all of us.
Okay, we've laid out the bull case, a structure built on massive revenue, incredible profitability, and overwhelming market momentum. And the skeptic has hammered away at that structure, revealing some potentially very serious cracks in governance and oversight. So it's time to weigh all the evidence. We've run the stress test. Now let's deliver the final verdict.
The iron case for ADI is, frankly, undeniable. You have explosive revenue growth, market-crushing returns, and a dividend that is as reliable as the sunrise. Wall Street is all in. This is a financial titan, a fortress of profitability. But the cracks in that fortress are deep. You have the fantasy of adjusted earnings versus the cold reality of GAAP. You have a CEO pay package that is just obscene. And most importantly, you have a board of directors that has basically admitted they are asleep at the wheel when it comes to the biggest risks facing the company. This isn't just some design flaw, this is a ticking time bomb.
So here we are. We're at the end of the stress test. The financial foundation of Analog Devices is like a slab of granite. The numbers, the momentum, the performance, it's all there. But the walls built on top of that foundation, well, they have some serious cracks. The governance is a major red flag. So the final question is really for you. With a foundation this strong, are you willing to bet that those walls won't come crumbling down? That's the stress test. The decision is yours. For Iron Financial, I'm the lead analyst, and I'm the market skeptic. Don't just trust us, trust the numbers, and please, do your own homework.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.